Hi, I'm Mike Costa, Chief Investment Officer of Next Step Portfolios. I work closely with the advisor team at Morrow on matters of investment strategy and portfolio construction. Essentially, my role is to support your advisor in the investment management process. I help turn over stones looking for new investment ideas that we can bring to portfolios. I also do background research with a view to making sure that portfolios are structured in such a way as to take advantage of long-term trends in markets and the economy. You can think of me as really just an added resource for what's already a very robust team here at Morrow. So from time to time, as you probably know, we produce short videos or letters when we think you'll want to hear from us. And over the past 2 weeks, markets have been drifting a bit lower, and so we thought perhaps this was one of those times. So what's happening specifically? Well, the S&P is down a little bit over 5%. I mean, it's changing from hour to hour, but it's down a little bit over 5% at the time of this video from its recent peak, 5% down from its peak. And some of the darlings of the S&P 500, particularly some of the big tech names that people are very familiar with, the household blue chip names, have taken it on the chin over the past couple of weeks. It's been a bad month for tech. So what's happening and why? We thought that would be something that you might want to hear a little bit about. So when it comes to the why, it can be difficult, in all honesty, it can be difficult to be totally certain. The market's not an entity or person of which you can ask specific questions and get concrete answers. You have to infer things. But there are several trends, many developments over the past month that do a pretty good job of explaining some of the recent price action that we've seen, some of the recent declines in share prices. And I'll highlight three of them and describe them a little bit for you. So the first would be valuations. Valuations are probably too high and frankly have been too high for large caps and in particular the tech shares within the US index. Secondly, the economy is slowing. At least we could say there are some signs that the early signs that the economy may be slowing. And lastly, politics. Politics have been adding to uncertainty, and investors just really don't like uncertainty. So let me put a little color around each of those three things. Firstly, valuations. When we talk about valuations, we're really talking about share price relative to current earnings or the future growth of those earnings. It tends, when share prices get very high relative to current earnings or potential future earnings, that tends to be a setup for that stock or that group of stocks to subsequently experience a period of weakness. So either flat share prices or declining share prices. Now, it's because you can't ever say with absolute certainty what the future holds for an individual company or even a sector. It can be difficult to pinpoint exactly how over or under or fairly valued a stock or a group of stocks might be. But I think there's enough information out there for us to say that it seems likely that tech share prices are a little too high and have been a little too high for quite a while. So why is that the case? Well, it's because investors have gotten very optimistic, perhaps even overly optimistic about artificial intelligence. Now, we do believe artificial intelligence would be a pretty big deal over time for the economy and for companies even outside of the tech sector. But that's not really the issue. The issue is whether or not all of the spending, the many billions and billions of dollars that tech companies are spending on R&D and chips and related digital infrastructure. The question is whether or not any of that capital expenditure is going to translate into earnings in a period of time that would satisfy investors. And I think when we're seeing the quarterly second quarter earnings come through right now, I think we're starting to see some signs that investors are perhaps getting a little bit more skeptical, or at least getting a little bit less patient when it comes to wanting to see some profits come through in association with those AI products. So that explains a little bit of the weakness in tech shares. We're also seeing, and as I said, some signs of a slowing economy. Particularly, we're seeing a little bit of weakness in the labor market. Now, that's no surprise, right? The Federal Reserve has put interest rates through the roof, and it's done that specifically and precisely to slow down the economy. The reason is because slowing the economy is one of the ways that they can bring inflation back under control, and that's their priority by legal mandate. Obviously, they don't want to sink the economy, but they do need to get inflation back down, and that's why interest rates are high. However, if interest rates cause the economy to slow too much, it could get to a point where that starts to make people feel a little bit uncomfortable, where people start to think, well, perhaps odds of a recession are rising. Historically, it's been the case that when we do see the economy start to slow, it tends to continue to slow. So that's the worry. It's really too soon to say whether or not the economy is going to slow just a little bit, which would be perfectly healthy because it helps keep inflation under control, or if it's going to continue to slow to get to a point where perhaps it would be bad for earnings and bad for stocks. Lastly, politics. As I mentioned, our presidential race has been getting a lot of attention lately. It's been a roller coaster so far. Clearly, it's been upended at once or twice, and we're not even anywhere close to November. We do see historically that the summer months are a little bit weaker for stocks, and we do see historically that stocks tend to be a little bit weaker on average in the months leading up to a presidential election. Why is that the case? It could be people don't like the mudslinging. It just kind of depresses sentiment, depresses the animal spirits that sometimes drive stock markets higher. It could also just be that investors just don't like uncertainty. We think Harris is going to be the Democratic nominee. We don't know that for absolute certain. Trump absolutely going to be the Republican nominee, but his policies, he has a habit of turning on a dime when it comes to a policy framework. So there's just a lot of uncertainty as to exactly, well, who's going to win, what they'll do, and what the impact of their policies might ultimately be. So investors don't like that. Those are three things we can point to. There are some others, but those are probably the main drivers and the reasons why the stock market's drifted lower this past month. Notably, small caps have been performing very, very well. Small caps are held in almost every portfolio. However, because larger companies dominate the equity market indexes, we say that the market has drifted lower overall. So the question, I suppose, would be, does any of this matter, right? Well, a decline of this magnitude isn't all that unusual. I mean, it's a tiny, so far, it's a tiny give back in the context of the bull market that we've experienced since markets bottomed during the pandemic. If you're fully invested in stocks, well, you'll have some exposure to international stocks, you'll have some exposure to small cap stocks, value stocks, and those will have offset some of the losses that we've seen this month in tech shares and in large cap growth stocks. If you're more of a balanced investor with a good helping of bonds, well, bonds have been relatively unaffected this month, so that will have supported and buffered your portfolio a little bit. So with the big picture in mind, I suppose we would say three things. One, the market moves that we've seen over the last couple of weeks aren't really particularly worrying. Secondly, if we see, not worrying in and of themselves, the second would be, if we see the economy slowing more quickly than expected, then we'll adapt accordingly. We know what to do in portfolios, and we have a game plan in place should that become apparent. Lastly, if stocks were to fall by much greater amounts than we've seen so far, normally we're going to look at that as an opportunity to actually add exposure to stocks, because although the short-term outlook for the economy and for companies in the US market can change dramatically over the short term, over the long term, we're bullish on America and we're bullish on owning stocks. So if we can own them at lower prices, all things being equal, the context matters, but all things being equal, we usually want to own more of those stocks at that time. So that's what we want to leave you with, a bit of cautious optimism. I hope you have a great week. It's a pleasure to have a chance to speak with you digitally, and don't feel shy about getting in touch if you have any questions or concerns. we're here for you. Thank you.